Hello, I'm Luke McCarty with McCarty Wealth, based out of Rockledge, Florida, and here are some of the questions I'm receiving from clients, along with a market update. When we're looking at today's markets, we're looking at tariffs, trade wars, and a market decline. It has been the fastest market correction, or sorry, one of the fastest market corrections since 1950, the seventh fastest. It took us 20 days to drop 10% in the markets. When we look at the prior six of these events that happened since 1950, you can see the 1 month, the 3 month, the 6 month, and the 12 month were all positive returns except for COVID. And you can see the average return after a 12-month period of a fast correction like we just had, the average is about 20%. So that is good news looking forward. If we think of this on the averages, and if we're 6 for 6 and we're about to could go 7 for 7, we could potentially see new all-time highs again, or back to all-time highs again by summertime. Our economic indicators right now are mixed with a positive outlook. Housing starts have been negative for several months, pretty much since interest rates started going up. Real personal income is positive, retail sales is positive. The civilian labor force is negative due to a recent tick up in unemployment, but we're about 4.1, 4.2% range, and industrial production is positive. We use these indicators to add or decrease risk to our portfolios. So if they're mixed with the positive outlook, we are still risk on. If three of these go negative, we start reducing risk. Four go negative, reduce even more. Five go negative. We're looking at potential 2008 and 9 type of event in the markets and the economy. So here's the Dow Jones Industrial Average Index drawdowns and market cycles since 1945. So we are currently in this top one, the -5 to -10% range. This has happened 40 times. It doesn't feel like it's happened that often because the last couple of years we haven't seen much drawdowns at all. But it's happened 40 times, and the average time to recovery is 3 months. If we go down the list with bigger drawdowns, we start getting, if you get to the -20% range, you're looking at more of a recessionary type of instance where they happen 5 times, and the -30 to 60 has happened 5 times as well. So the average time to recovery from where we currently are is about 3 months. That puts us into June, July timeframe, or the summer of this year to get us back to all-time highs again. So when we compare this to past historical events in the markets, this is very similar to 2018 and 19, where we had trade wars, we had tariffs, we had recession fears, we had housing slowdown, we had interest rate concerns. All of these are very similar headlines to 2018. This was the last time Trump was president. This was the last time he started adding in tariffs or using them as a negotiation tool. So when we look at this, if we remember what happened in 2019, the market was really strong. And it also, of course, it led up to COVID, but that was an anomaly where we cannot predict. So looking at this has happened before. It sounds familiar. We are increasing risk potentially right now and adding more equities to our portfolios, thinking that the bottom of the market is here. And this is the most oversold the S&P 500 has been since 2022. So these bands, I know it gets pretty choppy and confusing here, but the blue band is 1 standard deviation below the 50-day moving average. The red band is 2 standard deviations, and the green band is 3 standard deviations. Having an event that is 3 standard deviations in any one direction is very low probability. So what this means is the markets are very oversold. If it were on the opposite side and it were at the top of these bands, 3 standard deviations above, it would mean the market's overbought. So what this is leading us to believe is that, hey, the markets are very oversold. We're going to get a reversion to the mean, and we should kind of play in the middle in between the red and blue bands, and we rarely touch the green bands. And here we are below the green bands, meaning that it's very oversold. It was a fast correction, and we should turn up very soon from here if we have not already seen the bottoms of the market. Here's a chart on tariffs on U.S. imports. It takes us back to the 30s since we've had a lot of tariffs, but the far right, where it's kind of shaded in, different colors here, that's the proposed. The proposed tariffs are set to go into effect April 2nd. Now, I compared this to 2018 in a prior slide, but the markets bottomed before the tariff deadline last time Trump was president. Now, these tariffs seem to be a lot more proposed, a lot higher, and just a lot more of them. I'd say more aggressive on the tariff side. That's what's led to a big sell-off in the market. Your Magnificent Seven have not been that magnificent so far this year. They were great after the election. They were good in January, and then we've had a lot of choppiness and downside, into March and into February. Here's a chart on the Federal Reserve and interest rates. So what this is showing us is the blue dots on the right, and the blue squares here show that the federal year-end estimates are showing that there's a prediction in rate cuts. Jerome Powell spoke this week, and he said, we're going to keep rates steady. We're predicting 2 rate cuts this year. The markets like that because it's more expectations, less unknowns. And the market expectations here still show that the market is pricing in more rate cuts, which is why your mortgage rates have come down, interest rates have come down without the Fed making a move. And then the long run projection is about 3% from the Fed. So the times where we had the 0% interest rates or extremely low rates on U.S. Treasuries, I think are going to be hard to get back to. But history says, at least since 2008, and quantitative easing and Ben Bernanke and all the new policy changes, is we've been at 0% longer in the most recent history than we have had an interest rate. So I think a new norm, a good norm, should be around the 2 to 3% range. But we'll see what the Fed does when they vote on it almost every month. Here's the historical S&P 500 correction since 1965. So we're here in the top left, kind of in the dark blue and purple, and it's kind of average. So an average correction without a recession is down 15%. We're down about 10% right now. To get something over, 20 to 30% requires a recession. We do not see a recession on the radar right now. Our indicators are positive, mixed but positive outlook. So you can see here that the length of the recessions in history since 1965. International valuations. This is a case to own more international stocks in international markets because the United States has outperformed international for the last 13 or 14 years. Prior to that, from 2000 to 2009 and 10, international outperformed. But you can see here the bounce off the bottom. This is the international valuations. The price to earnings discount to the United States was a -2 standard deviation. So 2 standard deviations below, the average gets international valuations a lot higher, which means international stocks should perform and revert back to the mean. As I mentioned with the S&P 500, same thing with international. International has already started that. I think the S&P is on track to do it very quickly if it has not already. I like this chart because it's the time diversification, the volatility of returns. Going back to 1950, the green are stocks, the blue are bonds, and the gray is the 60-40 portfolio. So any given 1 year, you can see the wide variations in returns. The 5-year rolling turns a lot more positive from a percentage basis. The 10-year rolling, and you can see the 20-year rolling. So the longer your time horizon, the more it makes sense to be in stocks. Now, this doesn't have to be your time horizon of retirement. It doesn't have to be your time horizon of life, let's call it. It could be just the time horizon of you needing the money out of that investment. So we can see here stocks over the long run outperform bonds, outperform the 60-40 portfolio. We take a different approach here at McCarty Wealth. We use less bonds. We use more bond alternatives. We use more hedging. We use more other alternatives to to try and keep up with inflation more than what bonds historically do. Once again, I'm Luke McCarty with McCarty Wealth. Here's our contact information. Reach out to me if you have any questions. Follow us on YouTube, Facebook, and we will talk soon.